Have you ever wondered, when you have these investors that go out and find these properties, how do they fund the project? How does that happen? What if I don't have good credit? What if I don't have any experience flipping properties? Well, in this episode, that's what we're going to talk about today. How do I fund my project? Doesn't matter. Right here, I'm right here in Delaware, but it doesn't matter what state you're in, what city that you're in. The funding of these projects are done almost the same exact way. So we're going to talk about it. How do I fund a project depending on my experience level? And if I have like pretty decent credit, not the best credit in the world, how do I fund that project on this episode of the Mortgage Motivation Podcast?
The biggest crush ever branded on my brain. When I laid eyes on your back in the 6th grade. My first dream girl called her Ella Jane. She might have never.
All right, so first things first, anytime you're looking to make an acquisition is you buying a property that you want to buy for the flip. So if you want to do that, you got to have money to do something like that. So either you have the money to make the acquisition to purchase that flip, or you'll use something called a hard money loan. Okay, unless you have access to personal funds. So you have your personal funds, and you also have private money lending. Private money lending is if you know someone that's looking to lend you the money to help you out with your project. They may have their own personal terms of how they want to get paid. You know, what type of terms that they want to give you in order to pay them back for the flip that you're looking to start your project on. Or you could go the hard money route. And today, that's what I'm going to talk to you about is hard money. And how does that work? So hard money lending is a mortgage company that's willing to give you money for your flip project. Okay, it's not about how high your credit scores are. It's not necessarily about how much money you have to put down. It solely kind of leans on the project itself. So if you have a property that you want to purchase and it's a good purchase, then the lender would be more willing to look at this for you. And so what happens is, say for an example, you're looking to buy a home and it's worth $200,000, but the property may need about $50,000, $60,000 worth of work. So unless you have the money yourself, you have to get the money from a mortgage company. But what happens is, if you go through your traditional route of lending, they're not going to give you money for something that needs to be rehabbed, because the house has to be turnkey. Typically, the house has to be turnkey. So if you're going through a bank or if you call a mortgage company, a lot of times they're not going to have a project for you. They may not have a product for you, but hard money lenders, they specialize in rehab projects. So they understand that you're going to be doing work to the house. They already understand that you're looking for what they call an ARV, the after repair value. So after you do the rehab, how much is going to cost to get the project done, how much equity is going to be in the property. So I always like to say the property just got to make sense, because worst case scenario, and the lenders always think worst case scenario, if they had to take over this loan for you or take over this project for you, can they still turn this property around? So that's the first thing that they look at. So if you introduce a really good transaction to a lender, a hard money lender, then more than likely they'll fund the project for you. So let's break down just the benefits of going with the hard money loan. With a hard money loan, the first thing I would like to bring up is it's a fast turning funding for your project. So if you're looking to purchase a house and you don't have 30 to 45 days, most hard money lenders could turn that funding around within I'll say about 15 days. All depends on the situation itself. So you don't have to wait the 30 days or 45 days to receive the funding for this particular project for you. The second thing is the term. It's a very short term. So it could be 6 months up to 2 years. But most rehabs would take a few weeks. I've seen it take as short as 2 weeks to 3 weeks, all the way up to maybe 4 or 5 months of how long that project would take to turn that rehab around to put it back on the market. So it just depends. But most lenders, they're gonna give you a few months to get that done. Like I said, up to a year to have that project completed. So the turnaround is pretty quick. So you don't have to worry about signing up for a 30-year, because remember, this is a short-term loan because you're looking to do a fix and flip for this scenario. So with the fix and flip, quick turnaround, the rates are also fairly decent. The other thing good about a hard money loan, the rates aren't crazy. I've heard rates up to 20%, but with the lenders that we use, you can get a loan as low as 9%, 10%. It just depends on the experience level of you as an investor. So the more experience you have, the less of a risk you are to a lender. So if you can show that you've done a few projects and you're looking to borrow the money, and one benefit about using the same lender all the time is once you've shown them that you can do a rehab without any issues, not a lot of glitches, then what they could probably do is possibly reduce your rate for the rehab. So that's one good thing. So there's a lot of benefits of going with a hard money loan. The other thing is they're going to take a look at your credit, obviously, but I've seen lenders that will get you funded as low as 620 credit score. So they're not leaning heavily on credit because their main thing is looking at the project itself. So the credit scores are not the biggest thing in the world. Now, I'm not gonna even call this a con. They want you to have access to a larger down payment. So 20% down, 25% down, 30%. It's not uncommon for you to put that type of a down payment for a rehab project. All right. So like I said, remember, you're looking to use this money to flip this property around. So they want to make sure that you do have the means of doing that. Okay. And also you will have to show reserves. So a lot of lenders want to show at least 6 months of reserves. It could be up to 12 months. A lot has to do with the project itself and your experience level. So one thing I can say is not as, I would say, conservative as a traditional loan. If you go with a Fannie Mae product or even with a government loan, you have to show a lot more documentation in order for you to qualify. They just want to make sure the property makes sense for them to lend you the money on. But once it's done, then that is it. So that's a few of the benefits of going with a hard money loan. So to give you an idea of how it all works itself out when you go with the hard money. So just like with the traditional funding, you'll get yourself pre-approved. So we'll find a lender for you that's going to fund your project. So once you go out and find the home that you want to purchase, then what happens is you provide that pre-approval letter to who's ever selling the property. And then once you get approved, once you're on the contract, then that's when everything starts. So for a brand new investor, so I'm gonna just speak to you guys, for a brand new investor, you have to show that you've done these type of projects before. So I may ask for a list of addresses that you flipped before in the past. If you rented properties before, I may want to see the addresses that you use to show the lender that you do have the experience. The other thing is we want to show your bank statements to show that you do have the money as a down payment, and also that you can cover reserves. So with reserves, let's talk about that for a second. So that could be your checking account, savings account. If you have stocks, bonds, 401k, anything that's liquid, then we could use that for the reserves. And the reserves is used just to show that, okay, once you move into this home itself, or not moving to this house, once you start the project, that you can fund the project for up to 6 months. Now, towards the end, we're going to talk about a way that we can set this up where you may not need upfront money. But as of right now, that's how this all kind of comes together. So once you show that, we're going to get you, we're going to submit all those documents into the lender, and then they're going to have an inspection on the home itself. So they're going to send an inspector out to your house, to the home that you want to purchase. And then from there, they just want to make sure that it all lines up. So you're going to have a scope of work for the home that you're looking to do the rehab on. And so say if you're looking to replace a roof, you're looking to change some structural items, you're looking to put in drywall, new electrical, a new bathroom, they want to see the scope of work. They want to get an idea of what you're looking to do, and just to make sure it's something that really makes sense for the rehab project that you have. So what they're going to do is take a look at that and say, okay, well, you bought this house for $100,000, but you said that you're going to put $60,000 into this. And you say that once that home is done, it's going to be worth $300,000. So they just want to make sure that all that makes sense. They can review your scope of work as well as ensure that the ARV is going to be there at the end of the project. So the more clarity you have with that, the better you are with the general contractor that's looking to do the work for you. They just want to make sure that we are as accurate as possible so you can get approved for the funding. So once that is done, then you'll go to settlement like you would normally do after you do the title search. You'll go to settlement, and then once you go to settlement, then either A, they're going to provide you with money to start the project. So say that we set this up in a way where we're going to front you $20,000 up front, just as an example. So $20,000 would be for you to start the project, but going forward, the lender typically will approve 100% of the rehab work that's been done to your house. So if there's $50,000 worth of rehab work that's been done, you could break this down into stages. So say you use the first $20,000 to start the project. Once you're done with that, you call the lender and let them know, like, look, I've done all the work that I said I was going to do. And so they're going to send a representative out to the house. So the inspector will come out there to take a look at the rehab work that you've done. And then once they sign off on that, they will send a draw. So you put money into the project, they're going to reimburse you back for that. Now, you don't necessarily have to take the money up front, but if you need to, some banks will allow you to do that. But say you didn't have that as an option, especially for someone that's brand new, then what's going to happen is you pay for the project up front, a portion of it, and then the draw is sent back to you. You're basically being reimbursed back for that. But if you're looking to do like $50,000, $60,000 worth of work up to 100, whatever the number is, the lender is going to reimburse you back for that project. So that's really good. So think about it. It's kind of like a line of credit to a certain degree, but that's a lot better than you spending your own money on a project and receiving no type of reimbursement. That's the benefit of going with a hard money loan, because it allows you to do your rehab and for you not to take on all your risks. And that's one thing. Anytime you look to invest, you want to spread your risk out. And if you take on all the risk, if anything happens with that project, then you take on all the risk. You want to eliminate that as much as possible. So as you can see, there's a lot of benefits of going with the hard money loan, and also getting a project being turned around pretty quick. Now, the other side of this is, say you're not looking to flip a project. And I'm gonna end with this. You can do fix and rent or fix and hold. You know, people say it in different ways, but what happens is you'll use that same process that I just described to you. So once the rehab is done and you're completed with it, say you decide to rent this property out. And this is where the BRRRR method come in. So if you're deciding to go with the BRRRR method, and I'm not gonna break down the BRRRR method, you should know what that is. If not, I'll put that in the details of the video itself. But that's when you purchase your property and you do the rehab and you're looking to rent it versus doing a flip. So what happens from there is if we use the same lender, what we can do is take that short-term loan and make it into a long-term loan, and going with the DSCR, so debt service coverage ratio. So if you don't understand how that works, go back to my previous video. I talked about the DSCR, one of my favorites. But what happens is the lender will look at that same project that you just took on, and as long as the rent itself is more than the mortgage payment, then that's all we would need in order for you to refinance this into a 30-year loan or 20-year, whatever term you decide. But we're still not looking at all your documents that have something like that done. And you could put that into an LLC. It's probably already is when you did the flip though. But you could put that into an LLC. We'll look at the income from the property itself. And as long as the rent is more than the mortgage payment, then you will qualify. And if you want to take the cash out, and that's the whole thing. So this is the repeat part. So if you want to repeat that same process, you can do a cash out refinance with no prepayment penalty. No prepayment penalty when you're doing these type of projects, okay? So the lender already understand what you're looking to do. And just so you know, when we start this project, they're gonna always ask for what is this investor's exit strategy. So we're gonna let them know, like, okay, they're gonna go in and do a rehab, but they're gonna rent this property out. So the lender already they're ready for you to do that. So once that is done, then we could turn that short-term rental, that hard money loan, take you out of that, because it's not positioned to keep you in that for a long period of time. It's positioned for you to be in that project only for a short period of time. We'll make it into a long-term loan for you. And like I said, you can continue on with that process. So when it comes to rehabbing, when it comes to you trying to do something different for 2025, you want to consider doing this, because unless, like I said, unless you got a pile of cash yourself or you have private money that you can get from somewhere, hard money lending would be a liable option for you. So like I said, you can still purchase that property that you want to buy. Doesn't matter if it's in really bad shape or if it just need cosmetic work for you to do a quick turn. The biggest thing is you have access to funds. So don't allow anyone to tell you that you can't make this happen if you want to do this as a career, or if you want to do this even part-time. This is how it's done. So I know it may seem a little complicated, but there's a lot of different ways you could go about doing the fix and flip or fix and rent. But I just want to give you an idea of what the process is, so you understand that this is not as hard as you think it is. So if there's a will, there's a way. So just consider hard money lending. Consider trying this out, because what happened once you do a project, 1 or 2 projects, you get used to it, and we could just continue to do that over and over again. And before you know it, you have a dozen of properties under your portfolio because you started the process with a hard money loan. So hopefully this helps you understand how it works and how this could be done. But just know that you don't need a ton of money to make something like this happen, because to me, it's still better than you spending $100,000 and $200,000 out of your own money in order to purchase a property and be responsible for the rehab. So the benefit here is you can still make your acquisition, you still can have money for your rehab, and you still can find a way to start your new career. Or if you are already an investor, just letting you know that you can go this route as well. There's a lot of investors out there that never tried going with the hard money route, but I just want to get rid of all the misconceptions about the hard money loan itself. But like I said, a lot of times you're going to pay 9, 10, 11% interest only. Your payment is not going to be as high as a full payment, because it's the purpose of the hard money loan is to get you in and out of the project. It's not set for you to keep this loan for a long period of time, but there is a way of doing this, and this is how it's been done. All right, so that's basically how a hard money loan works. If you have any questions, feel free to reach out to me anytime about hard money lending. Affluent Mortgage has access to these lenders. We have over 10 right now, and we're ready to start funding out projects. So good luck out there. Look forward to working with you, and I'll talk to you soon. Peace.